have just a few minutes to talk about a very big topic, transition finance. And I'm going to start, first of all, my two panelists, you can see, I think the slide is up there. Karen Fang, and I can't even read the slide here, but Bank of America, Sustainable Finance, something, but there's a glare on the screen, so I can't see it. And Brian O'Hanlon from the head of Director of Climate Finance at, it's part of Rocky Mountain Institute.
Yeah.
But that's, anyway, good on. And I'm Joel, I can read that part for some reason. So I want to start with a bit of a provocation here, that what we talk about with sustainable transition finance is in some ways kind of old wine in a new bottle, which is to say that if you go out in the internet and talk to people in this room about transition finance, you'll hear a little bit about everything. That some of it's stuff that companies have been doing for a long time, some of it's not. So I'd like to start with you, Karen. First of all, how do you define transition finance at B of A, and do you even use that term?
Sure. Thank you for having us, and thank you all for attending today's session. I run sustainable finance at B of A. I would say that's an interesting debate, right? In terms of sustainable finance, climate finance, green finance, transition finance, how do you define all of this taxonomy? I think if you look at the EU or Japan or Singapore or even some of the United States Treasury, publication on what, transition finance is, where sustainable finance taxonomy is, you will see that largely speaking, I think we're talking about the true green stuff that's aligned with the Paris Treaty, that's really aligned with the 1.5 degree scenario. That's green. That's the true sustainable finance. And anything that's aligning is sort of the transition finance. I'm simplifying for everyone's benefit because I think taxonomy debate is really important. But we're going to get to this in a second, which I think in the real life when financing investments do happen, we can't be that rigid, but that may be the punchline. But anything that's not aligned is not sustainable finance, is not transition finance.
So if I'm a company...
So it's kind of three buckets.
If I'm a company and I'm working on my decarbonization, net zero goals, is any loans, or is that transition finance, or does transition finance have to do with something else?
So every company, unless you are truly net zero already across your scope 1, 2, and 3 emissions, one can argue, that's a good question, right? If you have carbon footprint and you have a plan to transition to a lower carbon business model, you would think that if we lend or invest in the company, whether it's in the equity part of the capital structure or debt part of the capital structure, it's broadly speaking transition finance because the company itself is transitioning its business model. Unless you're truly carbon emission zero today, I think it's probably pretty easy to argue that you're lending to the company, investing in the company, you're investing transition finance. However, I think we can be more specific on that. Activities that are happening on the project asset level, you can be more, green bonds and other things, you can track the user proceeds. If, for example, a company is installing, their own solar and wind power generation for scope 2 purposes, or the company is actually investing, through energy savings contracting, energy efficiency upgrades, those things can probably be more, defined as sustainable finance or green part of the activity.
Right.
But I think if you're talking about a commingled balance sheet and you're doing capital markets, you're doing lending and investing, it's hard to argue any company truly is net zero. And there will be exceptions, and there'll be those that should get a green medal. But I think a lot of the companies are on the way to a net zero model.
Yeah. So Brian, from your perch at RMI, how do you see the landscape right now? Or what companies talking about when they talk about transition finance, is that additive, or is it some stuff they've always been doing and it has a new label? How do you see it?
Well, I know you wanted to be provocative, but I think I'm in large agreement, I think, with what I've heard from Karen right now. Look, we're at a conference of sustainable finance professionals, and a couple of years ago, I think this audience will not be surprised that all of a sudden we realized that if we're going to actually participate in the decarbonization of the global economy, we need to somehow count what emissions we're enabling in the decarbonizing of the economy. And so you start to have to count, well, what does everything come from emissions? Now, the challenge is, as Karen just said, most companies are not fully decarbonized at this point, which means the next dollar of investment, either at the corporate level or from a financier, actually may or may not increase the emissions as we're writing this on paper. So I think we can very quickly get into needing to have strong, very clear, assured definitions of what transition finance is. Where I would say where RMI comes down is that we need some rough guidelines. I mean, there is a motivation on one side to raise funding and make claims that we need to be a little bit careful of. But at the same time, I think transition finance, we could hold this term, I would argue, rather loosely. We need to have enough guidelines to give people confidence to bank the transition. And that's going to happen at different paces and different speeds at different parts of the world.
Yeah, you bring up an interesting point there because GFANZ, the Glasgow Financial Alliance for Net Zero, defines transition finance as the money necessary to support an orderly, real economy transition to net zero. And I'm wondering, at what point does this transition become less orderly, where all of a sudden we're, arguably that's maybe starting, does that change what needs to happen? We're going to start with you, Brian.
Yeah, well, look, when you're talking about finance, I think finance often follows changes that are made in the economy. And so I think a lot of the orderly versus disorderly is actually in the hands of governments and also in the hands of all of us as voters and citizens to support where the governments move there. But I'll give you an example where I think that transition finance sits. Take an oil and gas company, which I think that nobody would define as sustainable from the business model. However, there are certain actions that you can do to either become more efficient from an emission standpoint or not. Well, what does that mean? Does that mean you actually count that towards accelerating? How do you create products to encourage that behavior? That's kind of the realm of transition finance that you need to begin. So it's not necessarily about speed, it's about what actually is contributing long-term to decarbonization versus not in the moment we are in right now.
Yeah, but long-term, short-term is an interesting piece of this because companies, as we all know, are working on fairly short-term, quarterly or even annually metrics. But most of this finance for this sustained, orderly transition is over a longer horizon, sometimes 5 or 10 years. How do you see companies and financial institutions balancing that?
I think we need both long-term goals and, frankly, short-term measurement, right? You need to actually make sure that you have a long-term goal that will match the pace of technological evolution, because we, frankly, don't really know all the technologies in green electrons, in green molecules that will carry us all the way there towards 2050. And the work doesn't end in 2050. Between 2050 and 2100, there is a lot of, for example, carbon capture we still need to do to make sure we stay at roughly a net zero environment. And frankly, some of the pace, you say orderly, I think it hasn't really been orderly in the last couple of years, given geopolitical situations, supply chain disruptions, cost of capital. You can call that a disruption too. Frankly, orderly to me is like a linear reduction of carbon emissions in the real economy going from 52 gigatons to 0. It doesn't happen that way because the real life doesn't happen smoothly like that. So I think when you think about that, if you actually look at the trilemma between, for example, take the energy and power sector, you look at the energy sustainability, which obviously governs the net zero work that we all do. But when you think about the energy security and you think about the energy affordability, right? When you think about kind of satisfying the trilemma, perhaps the transition the last couple of years, given wars and all the disruptions we just talked about, has been orderly because it's not just measured based on carbon emissions reduction or emissions intensity reduction. So I think we have to be extremely pragmatic when we think about transition finance, is that we have to be very humble. We don't know what the world, half the world is going to election this year, right? And you think about every election so far this year has been a surprise. Yeah. So we don't know what's going to happen politically, geopolitically. We don't know what's going to happen. We think we know where the rates are going to go, but we don't exactly know when and how. Yeah. And I think when we think about supply chain and reshoring and having a renaissance in manufacturing in America, it doesn't happen linearly and orderly either. So I think those are things we have to think about.
And that brings up another topic which is the word risk. Risk, there's the risk that you take as a financial institution every time you make a loan or underwrite a bond, but there's also the risk that companies face, reputational, transitional, right to operate, extreme weather, so many other kinds of risks. How do those fit in, and how do you think about that as a financial institution, the risk of the customer in this world of surprises, versus the risk that you're willing to make as a financial institution?
I think we've gotten really good. I mean, I'll think about this across 3 different pillars, right? Mature technologies in OECD countries. I think we've got a really, really good handle on that now, right? So if technology risk of wind and solar 15 years ago was a problem, I would say largely speaking, unless offshore wind, we have some hiccups there, largely we understand that. Energy, sort of renewable energy plus storage is probably where 90% of the financing in the climate finance world today is going to, right now. But you think about emerging technologies, all the green molecules we need, whether it's renewable natural gas, green hydrogen, so elusive, right? And thinking about all the other renewable fuels, including sustainable aviation fuels. Why is it so hard, even given the amount of incentives we're seeing in the IRA and the EU mandates? So both the carrots and sticks are trying to encourage all of this because we still have technology risk, engineering risk, performance risk, EPC wrap risk. I mean, these things are readily available today after 15 years of collective action in renewable energy plus storage. They're not yet available in emerging technologies. Emerging markets is the biggest elephant in the room. I think on top of all the risk factors we talked about, we have currency risk and political risk and geopolitical risk, and frankly, coup d'etat risk, right? I mean, that's part of the political risk. I mean, we know a lot of that from doing real life transactions, and those things are real. So. I think the de-risking needs to happen. It's not just the multilaterals, development finance institutions, the government, but I also think, when we look at the insurance industry, they have a huge role to play as well.
Yeah. Brian, what's the role for regulation in all of this? The EU has some definitions, legal definitions of transition finance. Singapore, I think, as well. How about in the U.S. Or other countries? Would that help us get further faster?
Well, look, I think regulation has, for modern American history, has had a key role that's inseparable to the infrastructure build-out that we've seen in this country. Whether you're talking about railroads, whether you're talking about roads. A personal story is I got my start in finance underwriting political risk insurance. And one of the hottest products that we had at the time was underwriting the risk that you would have incentive regimes for solar and wind that would suddenly change and blow up the market and lose investments here as well. That was a conversation that solely revolved around not emerging markets, but we're talking about Germany and Spain and the Czech Republic and certain U.S.
In California.
as well, right? In California. So I think regulation, a lot of the debates are around kind of theoretical ideas about whether or not climate is something that sits over here and modern economics and business is over here. And I think that the more that government can come to a consensus that we're just simply talking about the direction of the economy, which is something the government's been regulating forever. And then when you actually talk about incentive regimes, that they are sustainable long-term from a fiscal standpoint, that they make sense and that they don't straitjacket and try to get everything perfect from the get-go. So I think the more that government can just participate as an actor and also be humble, which is very hard, and that's not how the legislative process works, at least in this country, but there is a role to play there.
Humble government, that's a concept. Yeah. Karen, I want to come back to that, my opening provocation here, because the quote from Tan Zhenhui, who's the Chief Sustainability Officer at Fidelity International. And Tan said that the most severe form of greenwashing is in transition finance is when it's used as a way to, and this is a quote, extend traditional financing to heavy polluters without driving any real change in their underlying businesses. Is that an issue that you grapple with, or you see your brother and sister financial institutions grappling with as well? Because there's as you know very well, there's a lot of pushback around the financing that you and every other institution does around fossil fuels. How do you navigate that in this moment?
I think, first of all, this is the long-term, medium-term thing you're talking about, right? So when you think about our goal of 2030, we have emissions reduction goals for high-emitting sectors. Fossil fuel sector is included, right? Obviously, aviation, transportation, cement, steel sectors. So you measure. So A is you can look at a variety of things, right? Is your loan portfolio size to that sector increasing on an absolute dollar notional basis? Is the emissions and emissions intensity in your lending, which obviously we all have defined methodology of calculating financed investment emissions, is that increasing or decreasing, right? So I think it's actually pretty black and white for us in terms of not, leaving this to a subjective debate. It's sort of how much are you lending? are the lending, the financing, investment associated emissions coming down over time? What are the companies doing? Do they have a pathway to reduce their emissions intensity? Because you can say you're helping, but are they investing in methane leakage prevention? Are they doing CCUS? Are they looking at newer green electron and green molecule investments? Right? So these are all tangible things that you can actually disclose and compare.
Do you actually decline big companies who don't check those boxes?
We look at companies, look at their entire pathway, we do decline, frankly. And we have not increased, for example, our oil and gas lending size. I think it's in our 10K, everyone can look at it, right? But if you look at the emissions intensity, there should be, again, we're not measuring 2022 to 2023, because a lot of the technology availability, frankly, is not really there, right? If you say green hydrogen, I'll just challenge whoever thinks green hydrogen is reality today. I think we have a lot of great promising projects. We need those things to come online. Sustainable aviation fuel, you can set regulation targets to have people blend 10%, 15% by 2030, all you like. We can't seem to break the 2% production barrier. Yeah. So things like that is reality versus aspiration. So you can say, wow, your aviation emissions is not coming down fast enough. That's not really the company's fault, because we have to address the SAF production, for example.
In the little time we have left, I want to get to scale, scope, and speed. How do we get further, faster when it comes to transition finance? And along the, one way to think about that is when we meet back here at Greenfin 2026, what's the story you hope to be able to tell about how we got further, faster? So we're not just defining it here as we sort of are this year. Brian?
Look, I think by next year, I hope that we have examples where we're seeing real methane reductions when it comes to investments that are made into quote unquote dirty companies that have made massive impact here, and we can talk about the boundaries there as well. I hope that we have phase outs that we can talk through as an example of how this looks like. And frankly, I hope by that time next year, we're not having a debate about whether or not we divest versus invest. As a company that has been dedicated to the low carbon transition for 40 years, it's about believing in the vision of where we're moving here, not just trying to score whether or not you have a good or bad investment coming into place.
I would just say, look, I mean, for all the negative picture we can paint, last year global climate finance did reach $1.8 trillion. That's at a 25% CAGR from 6 years ago. Right? So if you do the compounding, you would say we'll get to $5 trillion in another 5 to 6 years. That's the good news. The bad news is that, going back to the 3 pillars, that's, by the way, how we think about it at Bank of America, is mature technologies, emerging markets. The middle pillar and the last pillar needs help, right? So on the first pillar, again, renewable energy, EVs, transmission, storage, those things just need to be permitted faster. We need to remove barriers for those projects to reach FID, final investment decision, as quickly as possible. Government has a role to play, private sector has a role to play, developers, financiers, and so on and so forth. That we know how to do. That's the no excuse category, talking about scale and speed. That's where you're going to see the most in terms of 24 Greenfin versus 25. But when you think about emerging technologies, we have a big elephant in the room. November election is coming. A lot of these projects are enabled because of IRA. Right? And then I think we don't have time to get into it, but I think a lot of the tax credits will stay because they're producing jobs and they're revitalizing communities. We hope that's the case. So a lot of these projects can pencil and they can produce more scale in SAF, in long duration energy storage, in CCUS. We're funding these projects right now, but I want them to be 10x and 100x, hopefully. Yeah. Emerging markets, I think we have a lot more. If we had a lot more time, we'll talk about that. But I think that's actually a very challenging area.
Yeah, the election thing is interesting because what companies and markets and financial institutions need is regulatory certainty. And we're in an era where we don't know that. So lots to watch, lots more to be thinking about. And I look forward to continuing this conversation down the line. Please join me in thanking Brian Hanlon, Karen Fang.